I just want to review a couple of things with you and then do the homework from chapter 1 and then get into chapter 2, right? And chapter 2 is a tough one. Chapter 1 is kind of simple if you just pay attention to a few things. But chapter 2 is a lot more complicated than chapter 1. Will require more of your attention, more of your time, right? So I just want to tell you that in advance. And it's a really important chapter because it's a building block type chapter, and it'll affect a lot of what we do after chapter 2. And also keep in mind, you'll have your first exam after chapter 2, right? So let's get into it. So the most important thing we did in chapter 1 was this topic of financial statements. That's what your homework problem is about. And why do we need financial statements? Because we want to communicate information about the company to the various users. We talked about all the different people that use these financial statements. When I say use, I mean they rely on them for information, decision-making information. And, you know, we like to look at it from the point of view of the investor and the creditor. What kind of information do they need to help make their decisions? But they're not the only parties involved in using financial statements. So these were the 4 statements: the income statement, the statement of stockholders' equity, the balance sheet. And I mentioned the statement of cash flow, but we're not really going to spend any time on it in this class. So what does an income statement look like? Right, here's your example. It has a heading, and see how the date is expressed, right? For the month ended December 31st, 2021. So you get this visual picture, right, of all the activity that took place between December 1 and December 31st, 2021. So what happened during that period as it relates to the income statement? Well, the company had revenues, service revenue. This is a company that doesn't sell a product, it provides a service. This was a soccer school, if you remember the example. So this company, and I like to use, when I see the word service revenue, when I see the word revenue, it's similar to what sales would be, right? When we use the word sales. I like to look at this number as a billing number. I billed my customers a total of $7,200. I provided services of $7,200, and I have a paper trail to back that up, all the invoices that I sent out to my customers during that time period. Now we'll see when we get to chapter 3 that, you know, there's going to be something called adjustments to some of these numbers, but for now, let's try to look at it that way. Now, we had costs of doing business. We had costs that we had to incur to help us earn that $7,200 of revenue. Those costs are called expenses. So in this particular case, we had rent and supplies and salaries, etc. We had total expenses of $6,000. If I subtract that $6,000 from the $7,200, I'll wind up with $1,200, and that's the profit, only we don't use the word profit, we use the term net income to describe that. So this company, the first month it was in business, December of 2021, they made $1,200, if you want to look at it that way. Right, now, statement of stockholders' equity. For us, in our class, all semester, stockholders' equity will be composed of these 2 parts, common stock and retained earnings. Common stock representing what the stockholders gave us to buy their stock, and retained earnings, how much profit the company, not did they just make, but how much do they keep? Because we know what they made. We just saw that they made $1,200. So we have this little statement that we put together, a column for common stock, a column for retained earnings, and total, right? We add the two columns across, and that's the total. We look at the beginning amount in those items. On December 1st, what did we have? Well, in this example, this was a brand new company, so they didn't have anything when they started, right? So whenever you have a brand new company, these balances will be zero to begin. But what happened during the month of December? And notice that we show the date the same way as the income statement. We issued common stock for $25,000. We had net income for the period of $1,200. And we just saw that on the income statement. And we paid out a dividend of $200. Now remember, dividends is not an expense. Dividends is taking some of the profit and sharing it with the stockholders. So it's not the same thing as an expense. So what are the ending balances in these items? Common stock, $25,000. Retained earnings, $1,000. The total is $26,000. Right? Now, the next statement we're going to see, the balance sheet, these two numbers here are going to drift over there. So the next statement we have is the balance sheet. And notice how on the balance sheet, the date is expressed a little bit differently, right? We just say December 31st. We don't say for the month ended or for the year ended. It's just December 31st. So what goes on the balance sheet? The balance sheet is a list of the resources of the business. Those are the assets. And where did they come from? Did we have to borrow to get them? Those are called liabilities. Or did the stockholders somehow contribute them? That's the stockholders' equity. Now, it doesn't matter which side you do first. It doesn't matter what you do first because, right, I mean, all the same information winds up there. However, since we just looked at stockholders' equity, why don't we just start with that? Stockholders' equity we saw, right, from doing this little statement. Stockholders' equity is $25,000 common stock and $1,000 retained earnings, total $26,000. Well, those numbers wind up over here. Common stock 25, retained earnings 1, total 26. Now you may want to do the liabilities next because there's a word that we can use to identify liabilities. Payable. Anytime you see that word payable, it's telling you you have a liability. So you've got accounts payable, salaries payable, utilities payable, etc. All those amounts added up to $14,000, all those liabilities. There's one other word, you may want to make a note to yourself. There's one other liability that we don't see here that we may see. I know for sure we will eventually see it. It's called deferred revenue. So deferred revenue is a liability that doesn't have the word payable in the name. Right? So just keep that in mind. We may see that even later today, I'm not sure. So 14 plus 26 is 40. So the total of the liabilities in the stockholders' equity is $40,000. Now that tells me that the total of the assets has to also be $40,000, right? Because we saw last time that there's something called the accounting equation that says assets equal liabilities plus stockholders' equity. So 40,000 equals 14 plus 26, which is 40,000. So anything that you have on your list that's left would be an asset. And here are some of the examples of the assets, right? Cash, accounts receivable, supplies, equipment, other. All right, so with that in mind, we can take a look at the homework problem. So we had problem 1-3A, and I see a lot of you've either done it or started it, and I'm encouraged by that. Thank you. And let's take a look at this this one. Very simple problem to get started, just so you get familiar with the financial statements and where things belong and how you refer to them, what are their names, etc. We have this company, Longhorn, provides low-cost food delivery services to senior citizens. At the end of the year, on December 31st, the company reports the following amounts. Somebody asked if I took attendance. I take attendance when I let you in to the room. Okay, so that's how I take attendance. And by the way, I got an email from the college that I have to do that. So last week I may have told you I won't do it all the time. I have to do it. They said I have to do it because there are people that like to crash these Zoom meetings. I can't imagine why someone would want to do that, right? But there are people, they say, that do that. Let me say, I gotta let somebody else in. Oh, sorry. Okay. All right. Okay, so we've got this problem now, and notice some of the things that it says here. They give you a list, right? And then they say down here, this is very important because without paying attention to this, you won't get the right answer. In addition, the company had common stock of 40,000 at the beginning of the year, and they issued an additional 4,000 during the year, and they had retained earnings of 18,200 at the beginning of the year. So this sounds to me, this kind of information would belong on that stockholders' equity statement, right? So if you don't pay attention to that, you won't get the right answer. So what do they want us to do? An income statement, a statement of stockholders' equity, and a balance sheet. All right, so this is problem 1-3A. This is on page 46 in the book. And let me get my book. Longhorn Corporation. Income statement. For year ended. For the year ended December 31st, 2021. Okay, and we always start with the revenues first and go through the list and look for the word revenue. And I see service revenue. All right, and I see the number is 67,700. Now be careful because sometimes they might give you two types of revenue. Right? They didn't in this problem, but I think we do one later on where they give us two different types of revenue. Like, for example, you could have service revenue and rent revenue, for example. Maybe you have some extra room in your building and you rent the space out. Right? You could have more than one source of revenue. Or maybe you have a little money in the bank and that money earns interest. You would have interest revenue. Right? So you can't have more than one type of revenue. Expenses. Now, expenses are easy because you're looking for the word expense. But there's one other word that you should look for also, and that's the word cost. So if I go through the list, I see that there's something called cost of goods sold. Right? And they also refer to it as food expense. So I'm not sure, the computer probably wants cost of goods sold as the answer, but I put that there because it's in the book. And that was $53,400. Right, and now what else did you have? What other expenses did you have? Just go down the list. I see delivery. Delivery expense is $2,600. And salaries. Right, and write the whole thing out. Salaries expense. Nice thing when you're doing the problem on Connect, you just type in the first few letters, right? And then the whole thing will come up and you just have to click on it. Any other expenses? I don't think so. That's it. We can add those up, total expenses. Comes out to 61,500. And then if I subtract 67,700 minus 61,500 looks to be 6,200. Is that right? Is my math right? And that's going to be called net income, right? Net income. So for the year ended December 31st, 2021, this company had a profit or net income of $6,200. So there's your income statement. All right, so now we can do the stockholders' equity.
I'm sorry, can you just go back up for like 1 second, please? Thank you, I got it.
Okay, statement of stockholders' equity, right? Oh, I spelled stockholders wrong. I'll just leave it. I spelled it wrong. I don't want to waste a lot of time. Again, for the year ended December 31st, 2021, and we're going to have a column for common stock. And a column for retained earnings. And a column for total. And we have beginning balances. All right, and go right to the book. Beginning balances, they told us $40,000 for common stock, $18,200 for retained earnings. So if I add those two things together, that looks like $58,200. Add. Okay, now what are we going to add? We issued additional shares of stock. Right, so they've told us that they issued an additional $4,000 worth of stock. Also, we're going to add net income. Net income we just calculated was 6,200, right? So let's put this 4,000 over here. 6,200 over here. Now, was there a dividend? I don't see any. Right? Companies don't have to pay dividends. Right, so this will be the ending balances, or you could put the dates in there too, right? January 1st and December 31st, but I'll say beginning and ending. So this is 44,000. This is what, 24,400, and that would make this come out to be 68,400. I should get my calculator out so I don't make gross mistake. $68,400 looks right. Okay, so that is correct. Right, and again, when you do the thing in Connect, it's already formatted for you. You don't have to do anything to make it look pretty. It already looks the way it's supposed to look.
Professor, I have a quick question.
Yeah.
All right, so when you do for add issued additional shares of stock, what exactly are you supposed to write in for the homework? Because like, are you supposed to just write stock or?
Just type in a few words and see what pops up. Something should pop up.
The only thing that comes up when you write up add though, it only comes up add net income.
Okay, did you type in issued or additional shares? Did you type in something like that? Because it should come up.
For some reason, it's not coming up for me.
Okay, well, type it in, you know, as much as you have to, but something should come up. Anybody else have that issue?
It only says issuance of common stock.
There you go. So
Is that
just put that in there then.
okay?
Anything that basically says the same thing.
All right, perfect. Thank you.
Okay. So now, right, if you look at your list, you can X out, you can cross out the revenue, you can cross out the expenses, and you can cross out stockholders' equity. So the only things that should be left on your list are the assets. All right, so we're going to do the balance sheet next. Longhorn Corporation balance sheet. Oh, balance sheet, not sheety. I don't know where that came from. December 31st, 2021. Okay, now they showed you the balance sheet side by side, right? Where you had the assets on one side and the liabilities and the stockholders' equity on the other side, right? Just to make things easier for me to do here, I'm going to put the assets on the top and the liabilities and stockholders' equity on the bottom, right? It just, so I don't have to reformat my whole page, right? But the numbers, you know, it'll work out. So we've got assets here. Right? Now, the asset that always comes first is cash. Always comes first. And in time, we'll see, you know, that there is an order to this. We list the assets in the order of their liquidity, which means how close are they to cash. Since cash is already cash, it comes first. Now, if we had accounts receivable, that would come next. but I don't see accounts receivable. I'm looking at my list. I see equipment. I see buildings. I see supplies. Supplies would come next. All right, supplies is 3,400. Buildings. Buildings is 40,000. Equipment. Equipment is 29,000. All right, I think that's it. I think that's it. Cash equipment. I think that's it. Okay. Total assets. All right, now I'm going to put that over here. All right, now I'm going to list the liabilities. And the liabilities, I'm looking for the word payable. So do I have anything with the word payable? I see accounts payable. Accounts payable 4,400. I see salaries paid. Now you see salaries expense, salaries payable. What's the difference? Well, remember, salaries expense is an expense. Salaries payable is a liability. For now, just be satisfied with that. We'll see when we get to chapter 3. We'll make the differentiation between salaries payable and salaries expense. Salaries payable, you owe your employees salary. They've worked, they've earned the salary, but for some reason you haven't paid it to them yet. All right, so that comes out to $5,200 total. Liabilities. Now we got stockholders' equity. Stockholders' equity is real easy because we already know what it is. Common stock, right, and retained earnings. And those numbers came off this statement here, right? 44,000 plus 24,400. Right, and that came out to 68,800. Okay, and that's total. Total liabilities. Liabilities and stockholders equity. Okay, so now comes the moment of truth. And I don't like what I'm seeing. I don't like what I'm seeing. So let's see if I made a mistake here somewhere. Let's see. Accounts payable 4,400, salaries payable 800. Because if I add this together, that comes out to $74,000. So there's obviously a mistake here somewhere, right? So let's see if we can find it. 1,200, 29,000, 4,400. You know, class, surprised no one caught me. Oh, wait. Oh, that's right. Did anybody catch the mistake?
Is it retained earnings?
44,000, let's see.
I'm just kind of confused why your retained earnings is 24,400.
Okay, 24,400, that's right. Right, that's right. 58,200, 4,000, 6,200, 68,400. Let's see if there's anything wrong here. 67,700 minus. That 6,200 is right. Okay, I'm baffled here. There's a $200 difference. So 4,400, 800 is 5,200, right? Let's see. 1,200, 3,400. 73,600. Now, a bunch of you did this for homework, so I'm just wondering if hmm. But you see what I mean here, right? The nice part about this thing is that you know whether you're right or wrong.
You know how you can check your work, right?
Yeah, you had to check your work, but I'm not doing it that way.
I just did it, and for some reason, it's saying the common stock on for 44,000 with stockholders' equity is incorrect. That's the only part that's saying it's incorrect.
Well,
It said that for me too yesterday when I did it.
right. Let me see. So you got a nice little simple problem like this, and it turns into a nightmare. Right? So 40,000, but that was the beginning balance, 40,000, and then they issued an additional 4, so that's 44. So I don't get it. Let me see.
Yeah, it just kept marking it wrong.
All right, let me try something. This is something that you don't have access to, I don't think. Well, I hope you don't. But let me say something. Sorry about this, class. I've used this problem for years, and I've never had this issue before. I don't understand. And, you know, sometimes you just take something for granted because it seems easy to you, and then something like this happens. But if it could happen to me, it could happen to you, right? Okay, so the net income is 6,200. That we got. This is 68,400. Here's the balance sheet. 73,600. I mean, unless I'm just making a stupid math error. Right? I mean, all of these are the numbers I have, aren't they? $4,400,
I see
800.
the error you made.
Okay, where is it?
Where it says your total liabilities and stockholders' equity, you have you have 68,800 when it should be 68,400.
Thank you. See, so it was something as basic as that. See? Now, I don't think you would have that problem in Connect because I think it does some of your addition for you, right? So just wasted a lot of time on something ridiculous. And so it was something as simple as that, okay? 68,400, not 68,800. And we had the 68,400, just copied it over wrong, see? So if I can make a mistake like that, I'm assuming you can too. So just be careful and, you know, never assume that your answer. Make sure you can prove everything out. Because otherwise you wind up wasting 10 or 15 minutes on something that should have been a snap. Okay, so that's it for the homework in chapter 1. And now I want to get into to chapter 2 with you, right? And chapter 2 is a very important chapter, and it's a lot harder than the chapter 1. Now, in chapter 1, we learned how to do those financial statements, and the financial statements are the end product. In other words, the accountant prepares financial statements when they're finished with all the other work. So in chapter 1, we did a problem and they gave us the numbers and then we just had to put them in the right order. You know, what goes on an income statement, what goes on a balance sheet, etc. But where do those numbers come from? Where do they come from? We have to keep track of each item that you saw on those financial statements, right? So go back to your income statement. You had service revenue. Where did that number come from? There were a bunch of things that happened to make that number up. It wasn't one thing, right? It could be a dozen different things that made up that $7,200 number. What about the expenses? Well, do I just pay all my bills on one day or do I pay them at various times during the month? Right? I could pay salaries every week, right? So salaries, I would have 4 payments to come up with that salaries expense number. Rent is something you only pay once a month as a rule, right? But again, go to your balance sheet now. Look at your assets like cash, for example. That number that you see for cash is what the balance of cash is in your checkbook at the end of the month. Well, during the month, how many things happened that affected your cash? How many deposits did you make? How many checks did you write? How many withdrawals from the ATM machine did you make? How many automatic debits took place in the account, etc.? I mean, you have a checking account, I'm sure, right? And you could have many different things happen during a month. Money goes in, money comes out. So we need to keep track of all the items separately. And the thing that we use to do that is called an account. So for each financial statement line, you have an account. And the accounts, they show you, go in this kind of order. We have an account for each asset. We have an account for each liability. We have an account for each component of stockholders' equity. But now we think of stockholders' equity as being common stock and retained earnings, but we're going to see that it's more than that. So what I want to do now is I want to walk through some transactions with you, right? And what's a transaction? A transaction is an event that occurs that affects this relationship, right? This assets equal liabilities plus stockholders' equity. In other words, this is an equation. And if something happens that increases the left side of the equation, then chances are something happened to increase the right side of the equation. If something happened to decrease the left side of the equation, then something probably happened to decrease the right side of the equation. Now, occasionally we can have a transaction where both the increase and decrease take place on one side. In other words, one asset increases, another asset decreases. I go out and buy supplies. Supplies is an asset, supplies increases, but I paid cash for them, cash decreases. You just have to remember that the equation must always be in balance. So let's go through some of these transactions and we'll see how they affect the equation. So the first transaction they tell us here is that the stockholders invested $25,000. So how does that affect the equation? Well, $25,000 represents cash. Cash is an asset that increased the left-hand side of the equation. Why did we get that cash? Because we gave the stockholders their shares of common stock. Common stock is on the right-hand side of the equation. That increased. Increased the left-hand side, increased the right-hand side. Right, now here's another transaction. We borrowed $10,000 from the bank and we signed a note. Notes payable. So what happened to the right-hand side of the left-hand side of the equation? I'm sorry. We borrowed $10,000 from the bank. Our cash increased by $10,000, right? Cash is an asset that increased the left-hand side of the equation. Well, what happened to the right side? We have a liability now called notes payable. Notes payable, that also increased by $10,000. So after those first two transactions, what's the total of the left? $35,000. What's the total of the right? 10 plus 25 is 35,000. Purchase equipment. Number 3. We purchased equipment with cash. So this is an example of one of those transactions that only affects one side of the equation. One asset increases, equipment, and another asset decreases, cash. So now what do we have? We have $11,000 in cash and $24,000 in equipment. Add that together, that's $35,000 on the left. What do we have on the right? Notes payable of $10,000, common stock of $25,000, total of $35,000. Okay. Pay rent in advance. Now, normally, when you think of rent, you think of an expense. If you are only paying 1 month's rent, it's an expense. But if you read what it says here, and don't ask me why they do this, I think it's really dumb. right? He's paying a full year's rent in advance. Who does that? Right? Only in an accounting textbook would you do something like that. So notice it says pay rent in advance. As soon as you see the words in advance connected with something like rent, that's an asset. It's not an expense, it's an asset. So they pay 1 year rent in advance, $6,000. We give that a funny name. We call it prepaid rent, and prepaid rent is an asset. And then other examples of prepaids would be something like insurance or advertising. Right? Very often, certain things we have to pay in advance. And if it's something that you normally think is an expense, but you pay it in advance, it's not an expense, it's an asset. It will eventually become an expense. By the time we get to chapter 3, you'll see that eventually that asset turns into an expense. It doesn't turn into an expense by itself. We have to do something. We have to make an adjustment to turn it into an expense. I hope I'm not confusing the life out of you. But here's $6,000. Now, this transaction is very similar to the one we just saw, right? We're creating an asset like equipment, and we're paying for it with cash. Here we're creating an asset, prepaid rent, and we're paying for it with cash. So cash decreases, prepaid rent increases, but the total, we add it together, it still comes out to 35. Total of the right side still comes out to 35. Okay. One more thing I want to just tell you. Whenever you see that word pay, whenever you see the word pay, it means your cash is decreasing, right? So whenever you see that word pay, it means your cash is decreasing. Because sometimes when you're analyzing these things, you know, something happens to increase something, something happens to decrease something, or something happens to increase whatever. It's also it's helpful if you can isolate things. So as soon as you see that word pay, you know you're going to subtract something from cash. So when you see the word purchase, it doesn't necessarily mean cash, because here you see an example, purchase supplies on account. When you buy something on account, that's accounts payable, which is a liability. It means you're buying something now, but you're paying for it later, right? The word payable means to be paid in the future. So when you're purchasing on account, that's accounts payable. If you're selling on account, that's accounts receivable. So you see the difference? Purchase on account, accounts payable. Sell something on account, that's accounts receivable, right? And we'll see that. I don't know if we'll see it here, but eventually we will see that. So here, we're purchasing supplies. We're not paying for them now. Purchase supplies on account, $2,300. So that means supplies is an asset. The left-hand side of the equation is increasing by $2,300. But we didn't pay for them. So that means that we have a liability now called accounts payable. That'll increase the right-hand side of the equation. So now when we're finished with all the adding and subtracting, what do we have? We have $37,300 on the left and $37,300 on the right. Okay. Now, they're showing you that we can expand this accounting equation, because right up to now, what did we say? Assets equal liabilities plus stockholders' equity, but we know that stockholders' equity is made up of common stock and retained earnings, right? We knew that from chapter 1. But what is retained earnings made up of? Well, retained earnings is really what? It's net income minus dividends. But what's net income? Net income is revenue minus expenses. Net income minus dividends is retained earnings. Right? So look how they show it here. Common stock and retained earnings. However, retained earnings is increased by revenue. It's decreased by expenses. See the minus sign? Decreased by expenses, decreased by dividends. So now we're going to look at some transactions, right, that are going to take this into consideration. Provide services for cash. Whenever you see those two words together, provide services, what does that mean? It means revenue. Whenever you see those two words together, provide services, that means revenue. And revenue goes over here. It goes on the right-hand side of the equation, under stockholders' equity. In this particular case, it said provide services for cash. Now, we know cash is an asset. And what does that really mean in plain English? Provide services for cash. You did something for your customer and they paid you at that time. Right? You did something for your customer. That's what provide services mean. And the customer paid you on the spot, as opposed to paying you later. And remember, this is a soccer school. They train customers. They teach them how to play soccer. Okay? So what happens here? Provide soccer training to customers for cash. Provide services for cash, $4,300. Cash increased. Cash is an asset. Right? But what else? Oh, come on, baby. Here we go. Right? What happened here? On the right-hand side, what increased? Retained earnings increased. Remember, service revenue increases net income. Net income increases retained earnings, right? So try to think of that relationship. Provide services on account. Provide services meaning revenue again, service revenue. And on account means accounts receivable. Accounts receivable. So provide soccer training to customers on account, $2,000. Increase accounts receivable. Accounts receivable is an asset. You did something for your customer and he's agreed not to pay you now, but to pay you later, right? And a lot of accounting students in the beginning, they're very uncomfortable with accounts receivable. What happens if he skips town? What happens if he doesn't pay? What am I going to do if he doesn't? Don't worry about that for now. Right now, just everybody pays, right? We'll see what happens. I think we get to chapter 7. We see what happens when someone doesn't pay, how we take care of that. But let's just assume that everybody pays for the time being. And you know what? If you did your homework and you did what you were supposed to do, you wouldn't have a problem collecting, right? And again, when we get to chapter 7, we can go into that. But instead of increasing cash now, we're going to increase accounts receivable, which is an asset, on the left-hand side, right? And we still have, on the right-hand side, we're going to increase the retained earnings for service revenue. Why? Right? Because an increase in revenue is an increase in net income. An increase in net income is an increase to retained earnings, right? Try to think of it that way. Okay, now here's just the opposite of accounts receivable. Accounts receivable, you did the work for the customer. You promised to do something for the customer and you did it, and the customer said, okay, I'll pay you next week. That's perfectly fine. But here's an example of where the customer paid you in advance. The customer paid you before you did any work. The customer paid you before you did any work. Well, that's not revenue. You can only have revenue when you've done work, right? In this case, doing work is training the customer. Well, here the customer paid you before you did any training. So what happens? Receive cash in advance from customers. You're going to increase cash, right? You have to increase cash. If the customer pays you, the customer gives you cash, you have to increase cash. Here's that thing I was talking about earlier, deferred revenue. Deferred revenue. Now, when you see those two words, what does it mean? Revenue, we know what that means, right? But deferred means it's not really revenue yet. See, the word deferred means later or postponed. This will become revenue later. Right now, what is it? It's a liability. So when the customer pays you in advance, that's a liability. Right? And you might say to yourself, well, how often does that happen? I mean, customers, it's hard enough to get them to pay at all. How am I going to get them to pay in advance? Some businesses, this is how they operate. In other words, if you wanted to take a flight somewhere, right? You wanted to say go on vacation to Disney World or something. Not that I guess anybody wants to do those things right now. But you just don't decide today to get on the plane and go to Disney World, right? You have to buy that ticket weeks or months in advance. The airline doesn't say, okay, just pay us when you feel like it. The airline says, if you want a seat on that flight, you've got to pay me today, even though you might not take that flight for 3 or 4 months. That's deferred revenue to the airline. That's deferred revenue. Your car insurance, for example. You don't pay for your car insurance every day before you get in the car, right? You pay for the car insurance in advance. That's deferred revenue to the insurance company. Now, when does that airline record the revenue? In other words, if I buy the ticket today for a flight I'm not going to take for 3 months, when does that deferred revenue become revenue? The day of my flight, when I get on the plane. So in this case, with the soccer training, when will this deferred revenue become revenue? When I provide the training to the customer. Right? And again, that's something that we'll see in chapter 3. This deferred revenue will turn into revenue when I provide the soccer training. Until then, I owe it to my customer, right? I owe this customer $600 worth of my time. And a common mistake students make is that they record that as revenue, right? Deferred indicates the company has yet to provide services even though it has collected the customer's cash. The company owes the customer a service, which creates a liability. Okay, pay. Now, as soon as you see the word pay, remember, means you're going to subtract something from cash. Pay salaries. Well, salaries is an expense. So pay salaries, $2,800. Subtract $2,800 from the cash, right? That decreases the left-hand side. What do you think is going to decrease on the right-hand side? Retained earnings. So remember, revenue, and this is indirectly, right? Revenue indirectly increases retained earnings. Expenses indirectly decrease retained earnings. Okay, pay, cash, dividends. As soon as you see that word pay, subtract from the cash. And what is dividends? Dividends reduces retained earnings. So pay dividends to stockholders, $200. Subtract $200 from the cash. Subtract $200 from retained earnings. And remember, dividends is not an expense, right? It's not the same thing as an expense. And here's a summary of the whole thing, right? And notice you come up with these numbers at the end, right? that if you wanted to do financial statements, you could, right? Using this spreadsheet as where you get your numbers from, right? And the problem we did for homework, they gave us a list of the numbers, right? But here are the numbers. So you could do a balance sheet just by looking at the numbers in these columns, right? You got cash, accounts receivable, supplies, etc. Right? You've got liabilities, accounts payable, notes payable, deferred revenue. You've got common stock, you've got retained earnings, and you could do your income statement by what? Taking these two revenues and adding them together and then subtracting this expense, right? So some accountants actually do use a spreadsheet like this to do all their record keeping. The reason why you really shouldn't is because it can get out of hand. It can, I mean, how many accounts? Some companies have hundreds of accounts. It would be, you know, difficult to work with a spreadsheet that's like 300 columns wide. Also, it gets confusing because, right, sometimes you're adding and sometimes you're subtracting, right? Sometimes you're adding, sometimes you're subtracting. So for that reason, accountants don't like to use the spreadsheet. They use something called an account. So notice, you see these things here look like the letter T? Those are called T accounts. And each column that you saw in the spreadsheet would have a separate account. And we're going to record the increases on one side of the account and decreases on the other side of the account. Now notice that they have the words debit and credit here. Debit and credit. Debit doesn't necessarily mean increases, and credit doesn't necessarily mean decreases. Debit means left, and credit means right. So if somebody says to you, debit that account, what does that mean? That means they want you to write a number on the left-hand side of the account. Now, in the case of assets, debits increase the account, and credits decrease the account. But in terms of liabilities and stockholders' equity, it's the opposite, right? Debits decrease the account, credits increase the account. And if we look at the expanded equation, right? The assets, the expenses, and the dividends all get recorded the same way. Increase with debits, decrease with credits, right? Assets, expenses, and dividends. Everything else, you increase with credits and decrease with debits, right? And there's just, you know, it's just something that you're going to have to remember. Maybe it's helpful if you have like this page in front of you as we start to do our work. Here they give you, what do they call this? A mnemonic. Dealer, DEA, dividends, expenses, assets, increase with debits, decrease with credits. Liabilities, owner's equity, revenue, increase with credits, decrease with debits. If it helps you to remember it that way, that's fine. Now what happens, this is what the account looks like when you're doing your homework in Connect. This is what the accounts will look like. Now here they show you the T, right? But what these accounts allow you to do is to keep track of the balance. Keep track of the balance. So after every transaction that affects that account, you know what the balance is. In other words, how much is in that account. All right, so for example, this was the first transaction that we saw. Remember the first transaction that the owners began the business with $25,000 in cash in exchange for shares of common stock? right? This is how you would record that transaction in the accounts, right? You put in the date, a debit of 25,000 to cash, and a credit of 25,000 to common stock. Okay. Right now, the accounts are very important. The accounts are where you're going to go to get the numbers to put on your financial statements. Right? That is where you're going to get the numbers to put in your financial statements. But the problem with the accounts is that they only show you one side of the transaction. So let's say you have an account. I mean, let's just go down towards the bottom of the illustration here, right? Let's say you have an account like this for cash. And let's say a year from now, your boss comes to you and says, what is this credit for $6,000? What is that for? That means I wrote a check for $6,000. I don't remember writing that check. I don't remember signing that check. You must be wrong. You must have done something wrong. How would you find the debit to the $6,000? When you look at the cash account, all you're seeing is this credit of $6,000. So what are you supposed to do? Review hundreds of transactions to find the corresponding debit for the $6,000? I mean, the credit to cash means you paid for something. Well, what did you pay for? Did you buy another asset? Did you pay an expense? Did you pay off a liability? What did you do? Right? You can't tell from looking at that. So what you need to have is another book. See, the accounts are contained in one book. The book is called the General Ledger. But we need to record the transactions first in something called a journal. And the nice thing about the journal is that it shows you the entire transaction together in one place. Okay, so first we would record the transactions in a journal, and then we would put the numbers in the account. So here's an example of what an entry in the journal looks like. Right? And again, this is that first transaction that we saw where the owners put $25,000 cash in the business and they took shares of common stock, right? What happened in that transaction? Cash increased, left-hand side of the equation. But now we're going to say debit cash. And what happened to the right side of the equation? Common stock increased, credit common stock. So debit cash, credit common stock, and then you put the numbers in the accounts. Right? And again, this is the journal entry you make first, debit cash, credit common stock, and then you put the numbers in the accounts, right? Debit cash, credit common stock. Now they take you through that whole illustration that we went over, right? For example, this was borrowing money from the bank, debit cash, credit notes payable, right? And then you put those numbers in the account. Cash, debit, notes payable, credit. And notice that we know the balance in cash. It's like a checkbook, class, right? You keep your checkbook. Every time you increase the balance, right? You add. Every time you decrease the balance, you subtract. But you always write what the balance is because you want to make sure you have enough money when you have to write the next check. All right, so I'm not going to go through all of these with you because we already went through them. Okay, but now what's the next step in the process? I mean, look at that cash account. How many transactions were recorded in the cash account? 1, 2, 3, 4, 5, 6, 7, 8, right? 8 transactions. So that $6,900 balance in cash, that's $6,900. That's how much money you have in your checkbook. That's $6,900. I need to know that number to put on the balance sheet for cash. right? But you see that one number is made up of all these parts. So in chapter 1, when we did the homework problem, they gave us the $6,900 number, right? But they didn't tell us how we got to that. So in chapter 2, we're learning how we come up with the numbers that go on the financial statements. So here they give you every entry for that illustration. We looked at the spreadsheet earlier, right? But this is every journal entry. And then this is what all the accounts look like, right? And now when we do a homework, we have 2 homework problems that we're gonna go over next week. This is exactly what we're gonna do. We're gonna do the journal entries first, then we're gonna put the numbers in the accounts, and then we're gonna prepare financial statements, but there's another step before you prepare the financial statements, because it's very easy to make mistakes when you put numbers in the accounts. You can put them in the wrong places. So we want to do something before we prepare the financial statements. After we're finished recording all the journal entries, after we're finished putting all the numbers in the accounts, we want to do something called a trial balance. And what's the trial balance? It's a list of all the accounts and their balances. And it's arranged in the same order the accounts would appear on the financial statements. So notice, these are all the balance sheet accounts. You see them? Starting with cash and going down to retained earnings. Actually going down to dividends, right? Because dividends affects retained earnings. And then here's your income statement accounts, right? Your revenues and expenses. So you list the accounts in the same order that they appear on the financial statements. You list the name of the account and the balance and whether it's debit or credit. And then you total the columns and you have to come out to the same number. Right? That's telling you that your equation is in balance. The total debits have to equal the total credits. And from that, you can actually prepare your financial statements. Right? They don't do it here because, well, we'll see, you'll see, because there's another step that should be done first that we learn in chapter 3. But let's see, what did we have for homework? We had 2 problems here to do. I just want to take a look at them with you so you get an idea what you're supposed to do. I think these were the 2, number 7 and number 8. Okay, so let's take a look at number 7, for example. Below are transactions for, I don't know if I'm saying this right, Udi Sewing Shop for March, the first month of operations. This is a new business. It's a sewing shop. They just opened in March. Here's a list of the transactions. These are a lot of the same transactions we saw in that illustration for the soccer academy, right? Same kind of things. Issue common stock, purchased a sewing machine, paid rent. Right now, this is not prepaid rent. This will be rent expense because this is just rent for March. Remember the example we saw, for some on God-forsaken reason, they paid a full year's rent in advance, right? That's not what's happening here. Here they're just paying rent for 1 month. When you pay rent for 1 month, that's an expense. Okay? And then they have some other transactions here. So what do they want you to do? Record each transaction, post to the T account, calculate the balance of each account, and then prepare a trial balance. And these are the names of the accounts that they use. So when you're trying to make your entries, these are the accounts you have to use. Don't make up something that you don't see here, right? Because it'll be wrong. You are going to be given the accounts. See where it says post each transaction to the appropriate T account? Well, in Connect, you'll have the accounts. So you won't have to like draw T's like you might see me do sometimes. Now, we also have to do number 8. I believe we had to do number 8. Now, what's the difference between number 7 and number 8? Well, number 7 was a brand new business, first month. This one is not, right? This company, these are the balances on September 1st. So this is the company's trial balance on September 1st. So you see all these amounts? These amounts need to be written in your accounts and labeled as beginning balances. So notice what it says here. See where it says here, calculate the balance of each account at September 30th. Be sure to include the balance at the beginning of September in each T account. So the first thing you should do before you even look at the rest of the problem, go to the T accounts they give you and write these amounts in, because otherwise you might forget. Right? Now you can look at the transactions. Record them first in the journal, then put them in the accounts, calculate the balance in each account, and then prepare a trial balance. All right, so just take a look at some of the transactions. Purchase, provide services for cash, right? Increase cash, increase service revenue. Purchase land with a long-term note payable. Increase land, increase notes payable. Received an invoice for $500 from the local newspaper for an advertisement that appeared on September 2nd. Well, advertising is an expense, right? Advertising is an expense. And when you see received an invoice, it means you didn't pay for it yet. So what is that? That's accounts payable. Provide services to customers on account. That's accounts receivable. Provide services means revenue, right? And on account means accounts receivable. Purchase supplies on account. Supplies is an asset, but now account means accounts payable. Here you're paying some of the note, right? September 2nd, you bought the land, but you didn't pay for it. You got a note. In other words, the person that sold you the land said, okay, you can just pay me over time. Here you're making a payment. Receive $5,000 from customers on account. Now, customers that owed you money are paying you. So you're going to increase cash and decrease accounts receivable. Pay September's rent, right? Pay means subtract cash. Rent is an expense. Pay the utility bill. Pay salaries. So pay rent, pay utilities, pay salaries. Very similar. Subtract cash, 900. Subtract from cash, 2,000. Subtract from cash, 4,000. Rent expense, utilities expense, salaries expense. Pay cash dividend, debit dividends, credit cash. All right, so those are the two problems we have for homework. These are not going to take 5 minutes to do, right? I would say probably between a half hour and an hour for each one. Don't try to do them both at the same time, right? Try to do one day and do the other one another day. And, you know, maybe if you don't have time to do it all at one time, take your time. You know, one day do the entries, then come back later and put them in the accounts. You can come back later and do the trial balance. You know, that's the nice thing about the homework. You don't have to do it all at one time. You can take your time. You can watch the videos. You can look in the book. And I think you'll be okay. But this is much tougher than chapter 1, as you can obviously see. Do you have anybody have any questions? I mean, this was a mouthful today, right? This was a lot.
Just when is the homework going to be due?
Well, The chapter 1 homework is due tomorrow. This homework is due next Friday. Again, go to your,
It says the chapter 1 homework is due the 11th.
let's take a look. Chapter 1 homework is due tomorrow. Chapter 2 homework is due on the 25th. All right, so we got 2 weeks to do that. We've got 2 weeks to do that. But again, don't wait until the last minute because you will go nuts, right? Trying to do all of this at the last minute will be very difficult. So
Wait, isn't chapter 1 homework due Friday?
do tomorrow. Yeah, day after tomorrow,
Oh, okay.
right? And again, I don't know who's asking. I don't want to know. You shouldn't have to ask when's it due, right? Because if you go on Blackboard, all the due dates are already there.
You have like an extra help time?
Do I have extra help now?
Yeah.
No. There's a learning center. So here's all your due dates for all your homework. Right, so you shouldn't really have to ask me because they're all listed there. And as far as extra help, or if you have questions, I mean, if you're doing a problem and you're stuck and you send me an email, I'll try to help you. But if you want someone to actually spend time with you, you have to do what it says here, right? Send an email to Bob Deanna, explain specifically what you need help with, and he'll take care of it. All right, but again, you have a lot of information at your disposal. You can watch the video for this class over again, which maybe, I don't know how good an idea that is, but you've got these videos here, these concept overview videos. Let's just see if we can look at one.
Recall that the two functions of financial accounting are to measure business activities of the company and communicate those measurements to external parties for decision-making purposes. The full set of procedures used to accomplish this two-step measurement or communication process.
I didn't care for that one. But again, I mean, you can go through this. No, you don't have to watch all of them, but you can just watch the ones you want to watch. This one was only 58 seconds long, right? So maybe you sit there and watch it. I don't know. Yeah, I don't know if they let you go out of order. They may not let you go out of order, so you may have to sit there and watch all of them. Right, but you know, again, it may be worth your time to do something like that because this is tough. This is not, you know, this is not something that you know intuitively. This is something that you have to learn and you have to teach yourself. You know, because I can't be there with you all the time. But if you want extra help, if you need extra help, contact Bob Deanna. His email address was right there. And just make sure you tell him what you want help with so he knows what to do, which problem, or understanding debits and credits. Let's see. The book is okay. The book is not bad. I mean, you know, you got to take the time to read it. You know, there's no shortcut. For example, they walk you through this whole thing about what a transaction is. and how it affects the equation. Remember, we only meet once a week, so I can't go over every single thing. These are all the steps in the accounting cycle, right? What did we talk about today? We talked about this. I really started with number 2. What impact does a transaction have on the accounting equation? If you think of the equation as something that's linear, assets on the left, liabilities, stockholders' equity on the right. How does the transaction affect the equation? What increases, what decreases? 2 things could increase, 2 things could decrease. I mean, you can't always just say one thing increases and one thing decreases. How does that relate to debits and credits? Prepare a journal entry, put the numbers in the accounts, prepare a trial balance, right? So those are all the things that we talked about today. This kind of summarizes everything. Number 1, I didn't talk about because in a textbook, you really don't come across that, right? Number 1 says, use source documents to identify accounts affected by an external transaction. In other words, you just don't make entries because you feel like making them. You have documents to back them up. You have invoices, you have contracts, you have other pieces of paper that more or less indicate what it is that you have to do. In our problems we do, they kind of forego that. They just tell you what to do. Right? So that's why I really didn't talk to you about number 1. But this kind of summarizes everything that we did. All right, so I think we're about finished for today. So that means we're going to have 2 more classes before the homework is due. That's good. So maybe we'll try to do 1 problem next week, and then we'll do the second one the following week, because that'll give me a chance to review it with you as we're doing it, so that you get more out of it. But again, don't wait till the last minute, because this is not something you're going to be able to do in a few minutes. All right, so anybody have any questions?
Yeah, Professor, are you gonna upload this this class too, like you did with the first one?
Yes.
Perfect, thank you.
What I did was I changed the page a little bit. I made a folder for each chapter. So this will be in the chapter 2 folder. I don't know what's going on here. But this will be in the chapter 2 folder. Right, because if you look, right, here's the chapter 1 folder. And then there'll be a chapter 2 folder as well. So this will be in the chapter 2 folder. I'll put the homework, a PDF of the homework I'll put in this folder. All right, but other than that, we're finished for today. All right, so if you get stuck while you're doing your work, you can shoot me an email. Contact Bob if you need extra help, but try it first on your own. Just don't go directly to get help. Always try to figure the thing out on your own. And if you can't after a while, then ask for help. But you'll be amazed at how much you can figure out on your own. All right, guys. So I will see you next week.
Have a good one.
Take care.